So I'll be discussing OECD's international tax reform, something that was actually recently passed, October of this year. Bit of a background on the tax havens and profit shifting that has inspired this work. Various sources have calculated that tax havens collectively cost between $5 and $600 billion a year in lost corporate tax revenue. Obviously, hitting low-income economies the hardest as a percentage of their GDP. Estimates are roughly around $200 billion in losses. In addition to this, we have noted that Fortune 500 companies just in 2017 alone had $2.6 trillion in offshore accounts, investments, and so forth, though a small portion of that has been repatriated through some of the reforms of 2018. Additionally, we have a few notable economists that have estimated that individuals alone have stashed between $9 and $36 trillion in tax havens, which puts the global income tax losses at roughly $200 billion on a more conservative note, in addition to the $600 billion losses in corporate taxes. So I think that we're relatively aware that we have also been seeing corporate tax rates fall progressively since 1985. They're about half of what they were at that point in time, which has contributed to the disproportionate struggle of low-income and developing countries. So to combat this, there's the OECD and G20 inclusive framework on BEPS, which is the profit or the base erosion and profit shifting, work that they've been doing to combat all these issues. And, for nearly a decade, they've been working diligently on addressing the challenges that we face due to antiquated tax regimes that fail to meet the needs of the globalized and digitalized economy. So a few achievements to date, as we can see, they've made some progress, and there are definitely a few steps in the right direction. But when we make our way down to the figures, where we see, $414 million in new revenue, that is merely 0.007% of the dollar amount being lost in corporate taxes alone every year. So we have a long way to go, and that is why that they're working on this really groundbreaking framework for international tax, and we're going to jump right into that and check out some of the key points here. So these international tax reforms are not seeking to eliminate tax competition, but rather place multilaterally agreed limitations on it. The measures that are directed toward multinational enterprises will be subject to a minimum of 15% tax rate. They're going to reallocate more than $125 billion in profits a year from these organizations. And the two-pillar reform has been agreed upon by 136 countries, representing 90% of global GDP, though there are still 4 countries who have not agreed to the terms, and we'll address this in future sections. And so just recap on what we're addressing here and why this came about. We have more than century-old brick-and-mortar-based international tax regime that, has nothing of value really any longer in a digitalized and globalized world. It's not providing the benefits that it needs to be. It's definitely not an even playing ground, which is what they're trying to establish here. And with the foremost concern, obviously, arising from digitalization and the technologies that are facilitating tax avoidance through various means. So we touched upon a couple of these, but we'll just highlight the key points again. We have $125 billion in profit that we generated and will aid greatly increasing both equality and revenue in low-income countries. Then we have, the 15% tax rate, which is really just going to add further benefits to the stabilization of the international tax system and the increased tax certainty for taxpayers and administrators. So a couple of the strengths and strategies that will be upholding this framework. First, upon reviewing the two-pillar proposal and the years of dedicated work to this, it's really pretty vivid that all of these individuals and, I would say representatives of countries have dedicated a lot of research, resources, planning, political power, and things to work on this reform. and its implementation. They're very consensus-based, focused on multilateral solutions, and have had an extensive array of stakeholder engagement activities, welcoming a lot of different opinions, from society, because they're seemingly working towards designing a system that actually works for the greatest number of people. Additionally, the provisions are providing capacity building things for developing countries so that they can administer the new regime, without any hiccups. And they're working in partnership with a lot of different organizations, development banks, extensive technological assistance programs, just really trying to facilitate cohesion. And also on the back end, or internally, they're creating a lot of mechanisms, working groups, and so forth to make sure that these frameworks are implemented in a consistent and more simplified manner. Not that this is a simple task, but they really are working toward trying to cover the bases on that. So there are obviously going to be some challenges here, and I'm going to highlight some of the ones that really just, it seems like there's a spotlight shown on them. Admittedly, the OECD has noted that failure to execute in the intended comprehensive manner will result in fragmented unilateral actions. It will diminish investment and economic growth opportunities, as well as, the government's ability to collect revenues and invest in public programs. So first, I want to really address the foremost reason why Kenya, Nigeria, Pakistan, and Sri Lanka have yet to join the agreement. They've noted that few multinational enterprises operating in their countries meet the profit requirement of this agreement. So this creates an issue, especially when these are the same countries that host many MNEs that have that pay digital taxes in their countries. So for them, removal of this digitalization tax would actually negatively impact their economy, because the value that would be added would be far less than what they're already receiving from their digital taxes. Additionally, the agreement does have some binding and mandatory arbitration for dispute resolutions. So this can be kind of a touch and go area, I think, especially if someone's losing sovereignty in the developing world to a country that the multinational organization is in. Yet again, it really comes down to this digitalization tax. I think this is something that needs to be reassessed. Concerning the exclusionary components, under both pillars, there are some exclusionary components that really should be intently scrutinized. Under the new tax agreement, they're excluding things like shipping, government entities, international organizations, nonprofits, pensions, investments, and these are excluded from the GLOBE rules. So what does this mean for the 14 firms who are responsible for organizing 29,000 offshore companies and 206 U.S. trusts and 22 U.S. trustee companies that were recently identified in the Pandora Papers, also in October, who are just shuffling trillions of dollars through offshore havens and shell companies? Or the additional 956 companies and offshore havens tied to 336 high-level politicians and public officials, including country leaders, cabinet ministers, ambassadors. Not to mention, we have secret offshore holdings of more than 130 billionaires from 45 different countries, 100 of whom have at least a collective fortune of $600 billion. And these are everybody from bankers, political donors, pop stars. So this is another area where it's very gray and nobody is manning the ship here. So we also have some more semi-related issues that propagated during this investigation, and that is the human rights and pollution violations, which a lot of these multinational organizations that are being set up under different guises and operating in developing countries are causing lots of environmental degradation and pollution that impede upon public health and the well-being of society. So when air pollution is causing more than 9 million deaths a year, namely affecting developing nations and costing over $8 trillion, then it seems that these things should be taxed accordingly. And it really feels like a significant missed opportunity to fully hold these enterprises accountable for the totality of their global impacts when addressing the tax situation. This impacts developing countries maybe even more, perhaps, than losing taxes from just international trade itself. This is 100% correlated, and it should be taxed accordingly. So this just leads into the considerations and the gaps here. Though the intentions of the OECD and G20-led international reform are honorable, they're relatively progressive, but they really may fall short of closing the gates to illicit financial flows and tax evasion, especially due to their exclusionary measures. Additionally, the narrow focus on MNEs in this international taxation ignores the potential $36 trillion of lost taxes from the evasion by billionaires and the wealthy. So with a spotlight shown on this exorbitant amount of questionable transactions within the domains here, it really seems like it would be the due diligence of the OECD to reconsider their approach and restructure this accordingly. Likewise, it would definitely be advisable for them to consider more flexible arrangements surrounding the digitalization tax in low-income and developing countries, particularly with regard to the proportion of income qualifying and non-qualifying multinational enterprises operating within their borders. It seems like this is a more simple fix and definitely needs to be addressed. But lastly, we have the tax reforms that are devoid the mandatory taxation for environmental damages resulting from the operations of natural resource extraction-based multinational organizations. These activities are well known to have devastating impacts. They are well known to have devastating societal and environmental impacts, particularly in developing countries. And so under which circumstances the MNEs should be subject to a baseline environmental tax damage. We're in the 21st century. These have been well-documented issues for years. And if we're redoing international tax system, this seems like a no-brainer. This really does seem like something that needs to be embedded deeply within our structures as a whole. And if we're taking on great measures like this should be represented here fully. All in all, though, the global tax reform is definitely moving in the right direction. All members need to take a really hard look at the gaps, though, that they're leaving open for organizations and individuals to continue to operate in the shadows.